Welcome to the G360 podcast. Today on the show, we have Jason Whitney of Whitney Pension Associates. Jason is the president of Whitney Pension Associates and a second-generation third-party administrator. Jason, welcome to the show.
Thank you, Sam. Glad to be here.
All right, Jason, let's set the scene. You're at a fancy cocktail party up in Vermont, where you're located, and somebody walks up to you and they say, Jason, what do you do for work? What's your answer to that as a TPA?
Yeah, that's tough to just say TPA. They've got that deer in the headlights look. So I usually start and just say I help administer retirement plans. But the crux of it, the base of all of that, is to help business owners of various sizes save for retirement, but also save on taxes, right? I mean, contributions to retirement plan are certainly tax deductible. So they like to hear that. If I haven't kind of scared them off at that point, to kind of say we're kind of like the mechanics of a 401k plan, kind of behind the scenes, making sure the plan is compliant, non-discriminatory in any of the contributions. I kind of just end it with typically a cross between a CPA and an attorney, right? So ultimately in charge of compliance and behind the scenes and making sure the 401k plans and retirement plans as a whole are operating smoothly.
Got it. So you're kind of the behind the scenes hero of the everyday American and business owner administering their retirement plan. So,
Yeah, hero is a big word, but yeah, we're behind the scenes for sure. Yeah.
so I don't recall any of my friends in middle school wanting to be a TPA when we went around the circle. I also didn't get many calling out financial advisor either. So how does one become a TPA? What's the process? Tell me
Oh
about Whitney
God,
Pension.
yeah. It's so funny. I actually, so you mentioned it on the intro that second generation. My father started the business back in '74, right when ERISA was passing, the Employee Retirement Income Security Act. At the time, he was studying to become an actuary, and then ERISA was enacted, and it said, hey, there's an opportunity here to administer retirement plans. So he and three other guys left. They were at an insurance company studying for the actuarial exam and started a TPA firm in Sacramento, California. Long story short, we ended up on the East Coast in Boston. I grew up in the suburbs of Boston, and one summer, I worked with my father, and I hated it. I hated doing it, all the work and the data entry. So, I went on my own way. Went to college, graduated, went to grad school, had my own career prior to this, and then circumstances changed a bit. I, got married, had a kid. I was out on the West Coast, and kind of called up my father again and said, "Hey, Dad, what do you think?" And here I am. Like 18 years later, still doing it. So you kind of just stumble on, and that's kind of the underlying theme of any TPA I talk to. They just like, you're right. You don't go to school for this. So you don't think desire to become a TPA because no one knows what it is, first of all. So
Yeah, and it's such an important role, especially working with entrepreneurs and small businesses and medium-sized businesses across the country. It's really a critical role that you play in administering folks' retirement. Who does Whitney Pension work with? Could you tell us about who your customers are and how you work with them?
yeah, any business owner, right? Certainly any from a sole proprietor, a single member sole proprietor, to we've got got a couple of hundred life plans, so two, three, 400 employees typically is our range of sizes. But the sweet spot is really just maybe even just a single a single solo K business owner up to about 20, 25 or so employees, kind of the professional organizations typically. I think doctors, attorneys, dentists. The demographics work really well. They've got some really decent income that we're able to help them shelter from taxes. So, certainly those we do work with nonprofits. We work with 403(b) plans, and those work out really well for retirement plans as well.
So let's talk about the types of plans, right? So from what I understand, the most popular plans are, I would assume, a profit sharing plan or 401k, the nonprofit cousin to that 403(b), and then cash balance and DB plans, right? Those are making a big comeback. The pension plan is back, but probably used in a
Deals.
different way than was initially intended. But could you walk me through those plans and what the benefits are and how you implement them?
Yeah, absolutely. So there's retirement plans. There's a lot of options for savings for his retirement. I'll kind of walk you through the beginning part of it. Again, so step one is potentially an IRA, right? You can save some money with an IRA. Don't need us for that. Um, the next available option for a business owner is a SEP, a simple employer plan, and that's just in essence employer contributions. And again, you will not need us for that because there's no document, there's no tax reporting. Next step from there is a simple IRA, a simple 401k type plan. Those have employee deferrals now. The limits are much less than a 401k plan, and and again, no requirement for a plan document or tax form filing. So that's kind of I like to reference as the minor leagues.
Yeah, the simple
I think
plans are giving me a little PTSD, right? Because every time we
they're
see one of those, they're absolutely impossible to open. Clients missing documents. They're generally pretty archaic, it seems.
yeah, they're not simple. I mean, that's for sure. And they're probably the most not abused, but there's most issues or there's no guidance, no oversight on to ensure contributions be made to employees' accounts per there is a plan document download from the IRS, but there really is no oversight. So yeah, there are headaches and there are individual accounts for some for you trying to manage all that yourself. I can't imagine doing that. So it's great. I mean, it gets people savings for retirement, right? That's the ultimate goal is the coverage of savings for retirement, helping employees retire. But it's got limited contribution amounts, and then there's also that kind of just do as you want kind of attitude to it. So not great, but it's a good step.
Yeah, those
I,
attitudes never really quite work out so well.
nah, they don't. But I like going from a simple to the next step now to the full blown 401k plan, right? Because they're used to having employee deferrals, contributions coming out of their paycheck. They're remitting those contributions to a custodial accounts, right? The assets are being moved to somewhere and they're being invested with you or whomever. And so they got the mechanics of it down. And so going from a simple to a 401k, and you mentioned profit sharing. 401k plans by design have a profit sharing component built into it. And so that is kind of a misnomer, I guess, in a sense. It doesn't really have to do with profit, but it's just strictly a discretionary employer contribution, where the employer now has the ability to go above and beyond what they could do on an employee deferral level. And I think this year is 23,500 with additional 7,500 and catch up if you're 50. So that's right around $31,000. If you want to get to that $71,000 limit that you're allowed to in your own personal retirement account each year, you got to go with the profit sharing type component to fill that gap. And so we certainly do a lot of those. It's a little more advanced on the calculations. There's discrimination tests we need to run, but they are probably the most popular plan designs out there right now for an employer with employees, 401k profit sharing plan. And just kind of sidecar to that, as you mentioned, 403Bs, very similar. They got their own nuances, but they're for not-for-profit entities that can set up a 403B plan that has the same mechanics. Is your employee deferrals that they're withholding. You can do a matching contribution on top of that, and you can do a profit sharing a contribution on top of those as well. So we certainly manage 403B plans as well.
And on the
Um,
403b, I think that's a pretty powerful offering because at Generation Capital we work with a lot of nonprofits, and we feel that they have kind of a startup nature in a sense, and it's really hard for them to get good advice or set up the plan, and it gets confusing and overwhelming. And generally that their key employees work really hard, so it's important to compensate them.
it is, and I think I know a lot of very successful 403 or not-for-profit entities, but some are just kind of just getting off the ground, right? And they want to have some sort of package or some sort of benefit to offer some employees to come work for them as well. And this is a recruitment tool, certainly having a 403B plan in place to allow them to start saving for time with a match, right? You can add a small match and say, hey, we're going to give you some money on top of the compensation we're going to pay you, but we're going to fund it through a retirement vehicle.
Yeah, that's really powerful.
It is.
So let's walk through before we get into. I think I would say we're probably medium, right? The profit sharing is more powerful than the simples, the SEPs, and the IRAs. Not as advanced as the DB cash balance. And just for our listeners out there, where these strategies are really powerful is the IRA contribution limits are generally very low, and for business owners that are have a positive P&L, you're not gonna be able to deduct those IRA contributions if you're earning more than 80 or so thousand, and then you get phased out of the Roth IRA. You could do the backdoor Roth, but oftentimes it's really de minimis compared to the overall picture. So where the profit sharing plans add a lot of power is you can actually have some volume here. So let's walk through a real life example of where this could be really powerful. Uh, let's say we have a married couple, and one of the partners owns a business, and the other partner works a W-2 job and is contributing their 401k. And that the other partner is working the W-2 job outside the business, also is contributing and on the payroll at the family business. We can really put that on steroids, right? Because now you could profit share to the partner working outside the business, and the other partner who owns the business can contribute up to 70 or so thousand tax deductible, or if they're younger, it might make sense to do Roth, completely tax free. Is that accurate?
Yeah, that's accurate. So in that scenario, we've got a lot of clients that are that way. You're right. The 70 or K or so you can get to individually. How you get there, portions of that is employee contributions, right? So that 23,500 and 7,500 on the employee deferral piece. And the rest of it's the employer portion of that. So if you have the partner and their spouse, the spouse has another job, go ahead and contribute the employee portion there to take advantage of it if they have a match or some sort of contribution on that side. So you get the full matching contribution on that end of it, and then make up the rest in the owner only plan. You can get you up to $73,000, and so that's a nice vehicle to almost double dip for savings for retirement for that type of situation.
So I imagine there's some not only complexity in these calculations, but legality. Are Whitney Pension Associates doing these calculations, and is it you personally? Are you sitting in a dark room doing these calculations? Who does this?
We are a bunch of neat nerds and geeks over here. It is good. We do kind of geek out on the calculations. So yes, we do these calculations. I have a staff of 4 full time. They're highly qualified. They've been doing it for a long time. So certainly they'll run the calculations. Everything will come across my desk for final review. But yeah, we'll run everything on different scenarios. We can run it 10, 15 different iterations to see how it works. It's a very complex calculation, certainly because you can discriminate now into a certain extent, but you got variables in there such as age, compensation, how they're taxed as an entity. There's a lot of different variables that come into play, but that's the fun part. That's the fun part for us.
Let's dive in a little bit about that discrimination term. What does that mean in regards to a plan? Are we talking about matching and how that works?
Yeah, every contribution that goes into a qualified retirement plan has its own discrimination test. The crux of those, the basis of the discrimination tests is what we're doing is comparing highly compensated employees versus non-highly, right? The definition of a highly compensated employee is ownership. Anybody that owns at least more than 5% of the business is considered a highly compensated employee. With that, there's also family attribution rules. So if a spouse or a child is also working there and they make $100 for the year, they're also still considered a highly compensated employee. So that's the bucket of the highly compensated. There's another definition. It is actually compensation. It's based on what you actually make on a look back year. So I think it was last year, if you made over $155,000, you're considered a highly compensated for 2025. So that's your group of highly compensated. Then we got to compare it to the rest of the staff, right? Those are the non-highlies. You're allowed to discriminate to an extent. Each contribution source has its variables. The 401k contributions, employee deferrals, right? So typically the owners have the means necessary to be able to max out their deferrals. Employees may or may not, right? They may be living paycheck to paycheck, or they just don't have they're paying off school loans or whatever the case may be. And sometimes those tests will fail because of those reasons. There's a popular plan design, what we call a safe harbor plan out there that satisfies some of those testing requirements. And it just means you basically have a required matching contribution you have to give to anybody that participates. So those are the employee deferral piece. The bigger one, the profit sharing, which we hit on a little bit earlier, has its own discrimination tests. And there's like 5 or 6 different ones you need to pass to satisfy that requirement. With those calculations, it is still the same basis, highly compensated versus non-highly. But the way we run all of our contributions is a new comparability class allocated type cross-tested allocation method. It's a mouthful, but really what it is just an age-based type calculation. Um, certainly the demographics of an employer come into play. So a lot of younger employees, it works out really well for the calculations. Because what we do is we take that, let's say we give $1,000 to a 25-year-old and a 55-year-old. The 1,000, and then we go ahead and convert that to a benefit. What does that mean to them at retirement? Certainly the 25-year-old means a lot more to them because they have 40 plus years to have that exposed to the market for growth versus the 55-year-old. So that's kind of just the really high level view of it, but that's how it works. And so it's it's quite complicated, but there's stuff that we can do that there's tricks and there's stuff that we can really tailor to target the owner and even the owner's spouses and children.
You guys are a bunch of geeks.
I know, it's fun.
But
Yeah.
that's those are all the action items that you guys take on the back end, right, to make sure that your customers are compliant and operating the plan as they should be.
Yeah, we always ask them, what do you want to do first off, right? So it's either one or two answers off of that. It's like, I want to get as much as I can to me. Cool, let's do that. And then we have to come up with a number to give to the rest of the staff, right? To pass the testing. Or two, their accountant says, hey, you did awesome this year in your business. You've got a $50,000 tax liability. Go buy another piece of equipment or something. I'm like, well, I don't need another truck. I've already bought stuff over the years. So how else can I shelter that from taxes? Well, let's talk about a profit sharing contribution to your retirement plan. And so that's how we come into play on there.
Well, let's talk about the advance plan. The accountant comes to you and says you owe 400,000 in taxes. You don't need 3 trucks. What is that little known way that you're implementing and helping business owners, defer taxes rather than donating that to the IRS?
Yeah, no, good question. And so I think a lot of those are some of the high net wealth earners, right? They've got a fair amount of income. So we still always start with the 401k plan and the profit sharing. So we kind of max them out, let's say it's $70,000 or so. And then I'm like, boy, that's not enough. We need to do more. We need to go ahead and think about adding a cash balance plan to it, to their existing plan. It's two plans, right? You got the 401k plan and then the cash balance plan. With the cash balance plan, it is a pension plan. It's got a lot higher limits. For an example, I had a sole proprietor last year. She was maxing out. She was an engineer, and so she got her to $70,000, but that wasn't enough. The CPA said, Jason, she's killed it. I need to get some more money into her account. So we set up a cash balance plan alongside the 401k plan. I was able to get her $285,000 into that cash balance plan as a contribution to her retirement and also shelter that from taxes. And so that was great. And then CPA called me up the next day. He's like, Jason, you just cut her tax bill by about $120,000 by contributing to her retirement plan. So
Yeah,
that's
three
the
hundred
real
and fifty
life.
thousand dollars of deductions in one year.
That's
That's real
correct.
money.
Yeah, yeah, deductions and there's expenses and not to go off the rails here, but there's whole other with Secure Act 2.0, there's these incentives to set up retirement plans. You get tax credits now. They're going to pay you to make contributions to the plan for 5 years. You're going to get a tax deduction and tax credits. So it's really is a good time a good time to start setting up retirement plans.
So the cost of engaging with Whitney Pension, you can, if you're setting up a plan, you don't get a deduction, you get a credit for that.
You get both. Yeah, so it's a tax deductible expense, right? I mean, we've got our fees, but it's a tax deductible expense. And then with the Secure Act 2.0 tax credits, you're going to get for the first 3 years up to $5,000 to offset our fees, and then an ongoing employer type contribution for 5 years. And so you're going to get the deduction for the contributions and then a tax credit for the contributions. So it's a win-win there.
I mean, that's powerful for you, for your business. It's basically free to engage with you with the tax credit.
That's right. And we're competing with now these state-run auto IRA mandates, which are great. I mean, they're encouraging employers to save for retirement. They're limited on the contributions they can make, but it's free. But so if we can offset that, say, well, we could be free for 5 years, let's say, and now you're getting a lot larger contributions to your retirement and savings on taxes. I think we've seen a lot of movement that's worked out well for us.
That's a pretty powerful IRR on that.
Yeah, yeah,
So
yeah, for sure.
so talk to me about some of our listeners that might say, well, I don't run a manufacturing business or, a medium-sized business, but I am a consultant or I am on a board that's paid and I have Schedule C or 1099 income. Can they do these types of plans?
Yeah, absolutely. Those work out really well. I have a lot of those actually. We got a lot of doctor right across the way here is Dartmouth College and the Dartmouth Hitchcock Hospital. So we got a lot of you know uh, high net wealth employees of those two entities, but they are also on a board, or they wrote a book, or they're an expert witness or something. They're getting this income, and it could be 50 to $100,000 a year that they don't need, right? They're getting their paycheck from their full-time job, and this is just taxable income to them, and they don't need. So what we do is we set up a solo DB plan, a defined benefit plan. It's the old school pension, and in essence, shelter all of it. You can put, up to, whatever. It depends on age and such, a lot of variables, but we could almost shelter 100% of that additional income from board income, from, expert witness, from a book. And they love that because that's now just being sheltered in away from taxes, and they're just put it away and save.
That's that's powerful, right? So if you're a sole proprietor or you're on a board, because now you don't have anybody to match to, you don't have any discrimination testing. It's just yourself. So theoretically, if you're doing consulting work or you're on multiple boards and you have high six figures, now we can bring your effective, and marginal tax rates down because you could make potentially, if some of the super funding techniques that you've educated us on and some of our clients, I mean, you could put 3, 4, 500,000 in a single year with combining in the profit sharing plan.
Absolutely. Yeah, isn't that great? It's crazy.
That Yeah, and the thought behind that, right, from our vantage point is let's control what we can control. And while you're working, we can take the deduction now and then either convert or distribute later and then do some tax arbitrage there. So you're saving a significant amount of taxes and anything inside the plan is growing tax deferred.
That's correct. Yeah, absolutely. Yep.
Let's talk about the last thing I want to talk about with you is implementation. So it sounds like coordination is the best strategy with these plans, right? CPA needs to be on the same page. The financial advisor needs to be on the same page because they need to open up accounts. What are you seeing with your most effective implementations? Hopefully they're with us and our CPA partners, but is it fair to say that these require a fair amount of coordination?
They do, but I don't want to make it sound so overwhelming, right? So you've got these three players, and even four. So in a retirement plan, it's like a three or four-legged stool. So certainly our end of it's the compliance side. You, Sam, is the advisory piece of it. The CPA comes into play because they know what they need for tax deductions. But then you've got a custodian of the assets, a record keeper, right? Something like a Fidelity where the assets are being held. So those all four need to coordinate on setting up the plan. But I think a lot of it is driven on my end initially. So we set up a plan document, and it's gathering information on our end. The EIN number, phone numbers, etc. We'll have a quick initial call with you, Sam, the advisor, or the client as well, just talking about what they want out of it, and then we kind of design the plan and draft it up. It takes 3-4 days on our end, and then we send it out for DocuSign via signature. And at that point, they've got a retirement plan. Then on your back end, you'll coordinate where the assets will be held, setting up an account or a brokerage account for those assets. But I don't think I've seen you work on that. It doesn't seem like a huge heavy lift on your end. You're well versed in it. So, I say that, the scary parts of setting up retirement plans are typically fees, and then it's going to be a lot of work. Well, with fees, we talked about, we can eliminate a lot of that up front. And then if you got a team working together like we do here, I think there's not a lot of work on that as well.
Yeah, the wonderful part about these plans from an investment perspective is, we use a Fidelity or a Charles Schwab, is they're totally open architecture. You're not limited to just, XYZ mutual fund in the plan. If you want to invest in private equity or private credit or hedge funds or structured notes or, a stock strategy, that's totally open architecture. You're not limited to the plan. To your
Yeah,
point,
exactly.
to your point, Jason, on the ease, I can tell our listeners as Generation Capital Advisors is a customer of Whitney Pension Associates, a very happy one. It's unbelievable at the speed in which that we can set these plans up, right? There's so much back end hard work that you and your team do, But ultimately, the plan documents typically, as you mentioned, are delivered in 2 to 5 days. I don't want to overpromise for some of our listeners out there, but and the plan's set up in about a week, and you handle the 5,500, and then with complete coordination with yourself and the CPA, those documents are distributed, and the plan kind of hums along. And there's some ongoing maintenance, but then it's the client's job to contribute.
Yeah. It's not turnkey, but we like to be as close to that as we can be. It's again, the roadblocks are cost and then the too much work. And so I think we can eliminate both of those and make it just in my I'm biased, but I think it's a no-brainer to go ahead and set up something like this if you've got the means necessary.
Yeah, absolutely. And to our listeners out there who are solopreneurs or board members and they have Schedule C income, this is just a no-brainer. If they don't need the cash now, save and defer and let it grow tax-free and take that compounding wealth, and that will really be meaningful in the future.
Yeah, and with which is new in the last couple years too. If you're thinking about, oh, geez, I would have liked to had that have happened last year to have this, this ability to save on my taxes. I got raked over the coals here. We still can, as long as it might be a little too late now. But if you got up until the due date of your corporate returns to set up a retroactive plan from the prior year. So if you're going over your tax planning with your accountants, your CPA, and they're going, geez, you really did a great, you really killed it last year. We need to find something. You still have time. So don't think that just because 12/31 turned over to the new year, you can't set up something, but you can. We can set up a DB plan, just a profit sharing type plan for the prior year to still get those tax deductions.
All right, so now we have a time machine. So let's say you had a really, really great 2024. Corporate tax filings are due 9/15. We can actually go back in time and make those contributions for 2024 at the date of this recording. We're June 17th. Sometimes I forget what day it is. We're June 17th, 2025. You can actually fund a 2024 plan.
That's correct. Yeah, it's got to be employer money only now, right? So you can't be any of those deferral pieces, but yeah, you can go back and fund just a DB plan, right? You can do 50, 60, whatever the numbers shake out to be, but it could be a fair amount of tax savings that you can do retroactively.
That's really powerful, and anybody who's not finished their 24 return, including myself, we should take advantage of these plans. And for a lot of our clients out there that haven't finished their 24 returns, or high net worth individuals because they're waiting on K1s, it is a good time to make sure that you're not missing an opportunity here. Jason, this has been hugely educational, and I think any entrepreneur or any individual or family that has 1099 income should contact you and set up one of these plans or have their plan reviewed. How do our listeners get a hold of you as we end with every podcast? The floor is yours for a Whitney Pension Associates plug.
Excellent. I appreciate that. Certainly can go through you, Sam, at Generation Capitals. We do a lot of business with you as well, so we appreciate that. So you certainly got all our information. But you can reach out to us directly. You can go to our website at whitneypension.com, or else give us a call. The phone number is listed on there. It's 802-296-6500. You can call. You can email me directly. I can provide it now, Sam. I guess it's jwhitney@whitneypension.com. If you want to shoot me an email, feel free to reach out and we just have a conversation. But any of those means, that even social media, we've got a Facebook and a LinkedIn page. So you certainly can find us either spot there as well.
Well, Jason, I really appreciate the time, and it is a lot clearer now why you don't take 45 minutes to explain what you do at a cocktail party. But the work you are doing is incredible, and the support of the small business community is really amazing. Thank you so much for being on today's episode. And to our listeners out there, please be sure to like, share, and subscribe. And if you'd like to reach out to Jason, we'll share his contact information.
Thanks for listening to the G360 Wealth Podcast. If today's episode gave you something to think about or act on, share it with someone who might need it. Don't forget to hit subscribe so you're always in the loop. If you want to learn more about how we help families like yours simplify and grow their wealth, visit us at generationcapitaladvisors.com. Until next time, take care and keep building. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Generation Capital Advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advice offered through Integrated Partners, doing business as Generation Capital Advisors, a registered investment advisor. The information in this material is for general information only and is not intended to provide specific advice or recommendation for any individual. Integrated Partners does not provide legal, tax, or mortgage advice or services. Please consult your legal or tax advisor regarding your specific situation. All investing involves risk, including loss of principal. No strategy assures success or protects against loss.